This daily chart shows Sun Pharma's price action approaching a major level. Look at this wide-range green candle breaking cleanly above 1800. Pushing an asset out of an 8-month consolidation base requires immense, sustained capital, exceeding retail capacity. To identify the source of this capital, we have to look at back-end delivery volume percentage. This metric isolates actual asset accumulation by stripping away speculative intraday trades. This data covers the last 5 months of trading. In April, delivery volumes surged to 64.91%. A rate of this magnitude, occurring precisely during the breakout, indicates institutional desks are actively pulling supply off the market. Structural shifts reach maturity when high delivery volume provides necessary support for the visible price action. The fundamental trigger for this activity was the massive 98,000 crore acquisition of Organon. The deal itself is incredibly complex. It facilitates a move into high-margin specialty segments like women's health, but it also introduces $8.6 billion in debt to the balance sheet. Mixed fundamental news often creates a period of hesitation and volatility as retail participants struggle to price in the conflicting data points. Institutions frequently use this window of retail confusion to quietly accumulate large positions before the new trend becomes obvious. The structural trend is not determined by the headline itself, but by how institutional order flow reacts to the news following the announcement. To understand the current expansion, we have to analyze the months of preparation that made it possible. On the weekly time frame, a horizontal channel emerged between 1600 and 1900, spanning 8 to 10 months. This accumulation phase lets large players build positions slowly, avoiding market alerts. Notice the sharp April drop dipping towards 1600 before an immediate reversal. This is a classic liquidity grab. By driving the price below a major support level, institutions trigger retail stop losses to create a temporary surge in selling. Large players use that flood of sell orders from stopped-out hands to fill their own massive buy orders at a lower cost basis. Professional accumulation relies on these engineered moments of weakness to absorb available supply without spiking the price too early. We can track the progress of this absorption by analyzing the volume bars at the bottom of the chart. Notice how volume dries up during the shallow red pullbacks. This suggests a lack of genuine selling pressure at these levels. This stands in direct contrast to the expanding volume bars that accompany every green upward move. The daily data from late April confirms this. One spike shows over 4.16 crore delivered shares, reaching a delivery percentage of 61.16%. This demonstrates the principle of effort versus result. The massive volume is the effort, and the sustained high price is the result. When high delivery volume sustains higher prices over consecutive weeks, it indicates a high probability of demand dominance over supply. Following the absorption of supply, the price structure transitions from a range into a sequence of higher highs and higher lows. This marks a shift where buyers become aggressive and sellers lose the ability to push the price back into the previous range. This transition is reflected in the moving averages. The 10, 20, 50, and 100-day averages are currently clustered tightly between 1700 and 1738. The current price holding cleanly above this dense cluster validates the underlying strength of the trend. The alignment of volume, price structure, and moving average support signals the start of the early markup phase. Rather than predicting the future, institutional analysts map out risk-reward parameters based on specific technical thresholds. To project future supply zones, we use the macro scale, tracking from the 2020 low to the current peak. Applying a Fibonacci extension calculates resistance levels with professional precision. The 1.0 extension sits at 2000, a major technical and psychological barrier. Before testing that macro target, the price must clear immediate resistance. This indicator shows the R3 level at 1818.06. Professional positioning involves moving through this structural map, where every price level dictates a specific protocol for managing the trade. The bullish scenario requires price to sustain its current momentum with continued volume expansion above the 1818 trigger. Reaching the macro target of 2000 is the next objective, and holding that level is necessary to confirm a new expansion phase. A bearish trap becomes likely if the price rejects at 2000 with high volume and long upper wicks, which would indicate that institutions are beginning to distribute their shares. The invalidation threshold for the entire bullish thesis is a breakdown below the 1700 zone. Breaking below 1700 means all the capital that bought into the 8-month base is now trapped at a loss. This converts those buyers into sellers, which can lead to a rapid trend reversal. Success in institutional trading comes from executing these predefined parameters rather than attempting to guess the market's next move. This analysis is for educational purposes and does not constitute financial advice.